Something didn't feel right when silver crashed. Not just uncomfortable or unexpected, but wrong in a very specific way. Prices didn't slide slowly. They didn't warn anyone. They didn't react to bad news. They collapsed suddenly, violently, and at the exact moment when public interest in silver was finally growing again. When something like that happens, the most important question is not why it happened. The real question is who needed it to happen. Because markets don't move like this by accident. They move this way when pressure builds behind the scenes and someone decides it has time to release it. And today, I want to walk you through why the silver crash was not a failure of the market, but a feature of it. Who benefited from it, who paid the price, and why what comes next may be far bigger than most people are prepared for. If you are watching this video right now, you are already ahead of most people. And before we go deeper, take 2 seconds to like this video and subscribe to the channel. This is Global Silver Truth, and this channel exists to expose what happens behind price charts and headlines. Liking and subscribing helps this video reach people who are still confused about what just happened in silver. And trust me, by the end of this series you will never look at a silver price chart the same way again. Now let's start with the moment everything broke. Silver wasn't weak before the crash. It's the first lie you need to understand. Demand was not disappearing. Industrial use wasn't slowing. Physical buyers weren't stepping away. In fact, many of them were doing the opposite. But on the surface, the price told a completely different story. And that disconnect is the key. We were told silver fell because of interest rates, or because of a strong dollar, or because traders suddenly lost interest. These explanations sound reasonable, but they fall apart the moment you look at timing. Interest rates didn't suddenly spike in 1 minute. The dollar didn't explode higher in seconds, and traders don't all panic sell at the exact same time unless something forces them to. Silver didn't fall. It was pushed. To understand how that happens, you need to understand what silver pricing really is. Most people believe silver has one market. It doesn't. It has to. One is physical, the other is paper. And the paper market sets the price that the world sees, even though it represents far more silver than actually exists. In the paper market, silver can be sold without owning it. Contracts can be dumped without metal changing hands. And when enough of those contracts hit the market at once, price collapses, even if physical demand stays strong. That's not theory, that's structure. The silver crash happened in paper first. Massive volume appeared in a very short window, during thin liquidity, when it would do the most damage. That is not how real sellers behave. That is how price managers behave. And here's something critical most people miss. When silver crashes like this, it is almost never because someone wants out. It is because someone wants in, but at a better price. Think about it logically. If silver were truly unwanted, there would be no urgency to smash it. You don't need speed, force, and coordination to exit a dying market. You only need that when a market is becoming dangerous to control. And silver was becoming dangerous. Retail interest was rising, physical demand stories were spreading, confidence in paper pricing was being questioned. That is when control systems respond. Not with explanations, but with force. So the crash came. Screens turned red, stop losses triggered, margin calls hit. Fear spread instantly, and within hours, the narrative was already written. Silver is broken, silver is dead, move on. That narrative is not for institutions, it is for you, because fear creates sellers, and sellers create opportunity. While retail investors were dumping positions, something very different was happening quietly. Physical silver did not flood the market. Premiums didn't collapse the way price did. In some areas, availability didn't improve at all. That should immediately raise a red flag. If silver were truly being abandoned, metal would be everywhere. It wasn't. What you saw was not a supply event. It was a confidence event. And confidence is far easier to break than fundamentals. This is why Global Silver Truth focuses less on price and more on behavior. Price is what they show you. Behavior is what they hide. And the behavior during the crash tells a very clear story. Weak hands sold. Strong hands waited. But now we need to go deeper. Because the biggest beneficiaries of this crash were not traders. They were institutions that needed time, metal, and silence. Silver is not just an investment metal. It is an industrial metal, a strategic metal, a military metal, and unlike gold, it is consumed. Once it's used, it doesn't come back easily. It makes silver far more dangerous to misprice. Industrial users don't chase rallies. They wait for crashes. Governments don't buy headlines. They buy quietly. And bullion banks don't lose control unless they allow it. Which brings us to the most uncomfortable truth. The silver crash wasn't about profit. It was about positioning. By forcing price lower, they flushed out speculative demand. They discouraged new buyers. They reset sentiment. And they created the perfect environment to accumulate without competition. That is not market failure. That is market design. And here's the part that should make you pause. Every major silver crash in modern history followed this exact pattern. Sudden collapse, public fear, media dismissal, quiet accumulation, then later a supply problem nobody saw coming. We are still in the early phase of that cycle. Right now, silver feels boring again, painful, unloved. That is exactly how engineered bottoms feel. Not exciting, not dramatic, just exhausting. And exhaustion is the goal, because when people stop paying attention, real moves are prepared. In the next part, I'm going to show you exactly who benefited the most from this crash. It's how they positioned before it happened, and why retail investors were always meant to be on the wrong side of this move. So stay with me. After the crash, silence followed. And silence is never empty in financial markets. Silence is where positioning happens. While headlines moved on and commentators declared silver irrelevant again, the real activity shifted out of sight, because the people who truly benefited from the crash were never emotional about silver in the first place. They were strategic. To understand who gained the most, you have to stop thinking like a trader and start thinking like a system. Traders react. Systems plan. The silver market is not controlled by reactions, it is controlled by structure. The first major winners were the bullion banks. This always makes people uncomfortable, but it is unavoidable. Bullion banks are not guessing. They sit at the center of the paper silver market. They see positioning before the public ever does. They know when speculative interest becomes dangerous. They know exactly how much pressure the system can tolerate before it needs a reset. Before the crash, commercial short exposure was already being adjusted. That is public data, but almost nobody looks at it correctly. Retail traders were increasing exposure. Confidence was building. The imbalance was growing. Once that imbalance becomes large enough, price action is used to correct it violently. The crash forced margin calls. It forced liquidations. And it allowed banks to reduce risk at a lower price without competing with public buyers. That is not manipulation in the cartoon sense people imagine. That is risk management inside a controlled pricing system. The second group that benefited were industrial buyers. And this part is critical because it explains why silver cannot stay cheap forever. Industries that rely on silver do not speculate. They do not chase momentum. They wait for price breaks. And when those breaks come, they secure supply. Solar manufacturers, electronics producers, defense contractors, and energy infrastructure suppliers all depend on silver. None of these sectors saw demand collapse. In fact, most projections continued to rise. Yet silver prices fell. That contradiction only makes sense if price was being temporarily disconnected from demand. Lower prices gave industrial users breathing room. It allowed contracts to be renegotiated, inventory buffers to be rebuilt, and long-term supply to be locked in quietly. No press releases, no announcements, just execution. The third and most misunderstood beneficiaries were governments and sovereign entities. Officially, silver is rarely discussed as a strategic asset. Unofficially, it is impossible to ignore. A world moving toward electrification, digital infrastructure, and military modernization cannot function without silver. Governments do not buy silver the way retail investors do. They don't chase spot price. They don't announce accumulation. They use intermediaries, long-term contracts, and strategic reserves. And the best time to secure metal is when public confidence is broken. A silver crash creates political cover. It removes urgency. It makes accumulation look unnecessary. That is exactly when it becomes easiest. This is why global silver truth exists. Because mainstream analysis focuses on what people say, not what they do. And behavior after the crash tells a very different story than headlines. Look at ETF flows. retail sold. But physical metal did not suddenly flood back into the market. Look at refinery output. It didn't spike. Look at premiums. They did not collapse proportionally. These are not signs of a dying market. They are signs of a controlled one. Now let's talk about who lost. Retail investors lost confidence. Not because silver failed, but because price was weaponized against them. New investors were scared away. Long-term holders questioned their thesis, and many people exited positions not because fundamentals changed, but because fear became unbearable. That emotional damage is more important than price damage, because once people associate an asset with pain, they avoid it. And avoidance creates opportunity for those who can afford patience. The crash was designed to make silver feel boring, broken, and dangerous all at once. That combination kills momentum better than any headline ever could. But here's where the story gets more interesting. Crashes like this do not fix underlying problems. They delay them. And silver has problems the paper market cannot solve forever. Supply growth is limited. New discoveries are rare. Recycling cannot scale fast enough. And industrial demand is not optional. Every year silver is consumed, not stored, not hoarded, consumed. That makes suppression expensive over time. That cost accumulates quietly. Right now, the system is buying time. Lower prices reduce pressure. They calm narratives. They give the illusion that everything is under control. But control does not mean resolution. And this is where most analysts make a fatal mistake. They assume the future will look like the past. They assume silver will always be smashed when it rises. They assume suppression is permanent. History does not support that assumption. Every suppression regime eventually ends, not because of rebellion, but because of math. Because physical reality always catches up to paper promises. The silver crash bought time. It did not solve the problem. And the longer silver is mispriced, the more violent the eventual adjustment becomes. This is why what comes next matters more than what just happened. In the next phase, you will not see fireworks immediately. You will see small signals, delivery delays, contract changes, language shifts, increased emphasis on substitution and efficiency. Those are warning signs, not solutions. System always whispers before it screams. And by the time silver moves in a way that cannot be ignored, the easy positioning will already be gone. If you are still watching this, you are doing exactly what most people don't. You are staying present when the market wants you distracted. That alone puts you ahead. In the next part, I'm going to explain what the next phase of this cycle looks like, how sentiment changes before price does, and why the biggest move in silver almost always comes when people least expect it. Stay with me. After every engineered crash, there's a phase most people completely misunderstand. It's the phase where nothing seems to happen. Price goes sideways. Volume dries up. Media loses interest. The public slowly forgets why they cared in the first place. Most people think this means the story is over. In reality, this is when the real story begins. This phase is not boring by accident. It is designed to be boring, because boredom is more powerful than fear. Fear makes people sell fast. Boredom makes people leave forever. And the fewer people watching silver, the easier it becomes to prepare the next move. Right now, silver is in that exact phase. After the crash, the market didn't bounce the way people expected. There was no dramatic recovery, no excitement, just slow, uncomfortable stagnation. And that has convinced many investors that silver has failed. But failure would look very different. Failure would look like oversupply, collapsing industrial demand, and excess metal everywhere. That is not what we are seeing. What we are seeing is quiet tightening. This is where sentiment and reality begin to separate. On the surface, silver feels weak. Underneath, it is becoming harder to source, harder to replace, and harder to ignore for anyone who actually needs it. And those people are not traders. They are manufacturers, governments, and planners. Here's an uncomfortable truth. Silver does not need investor excitement to move higher. It only needs industrial pressure. And industrial pressure builds silently. And most people assume price leads reality. In silver, reality leads price. Always has. So when industrial users start worrying about supply continuity, they don't announce it. They don't panic buy on the open market. They lock in contracts. They secure long-term deals. They increase inventory buffers quietly, and none of that shows up on a price chart until it's too late. This is why price suppression works for a while, but never forever. Because you can suppress price, but you cannot suppress consumption. And consumption is the ticking clock in the silver market. Every solar panel uses silver. Every advanced circuit uses silver. Every military system that requires reliability uses silver. None of those uses are shrinking. Most are growing. None of them care about paper futures pricing when supply risk increases. The crash created the illusion that silver was abundant again. That illusion is temporary. What comes next is not a straight rally. It never is. It is a slow change in tone. Analysts stop calling silver dead and start calling it interesting again. Industrial reports begin mentioning tightness. Substitution talk increases, which is always a sign of strain, not abundance. Then come the small stories. A delivery delay here, a contract adjustment there. Nothing dramatic. It's just enough to signal that something underneath is changing. By the time headlines say silver shortage, the move is already advanced. This is where most retail investors get trapped. They wait for confirmation. They wait for price to tell them the story. But price is always the last messenger. By the time it speaks clearly, positioning is already crowded again. That's why this crash mattered so much. It reset positioning. It cleared emotional buyers. And it gave long-term players exactly what they needed: time. Global Silver Truth focuses on this phase because this is where most mistakes are made. People assume nothing is happening because nothing is loud. But markets don't move on noise. They move on pressure. And pressure is building. Another thing most people miss is how narratives shift before moves. Right now, the dominant narrative is resignation. Silver is manipulated. Silver never moves. It's not worth the stress. That narrative appears at every major long-term bottom in silver history. Hopelessness is not random. It is the emotional end state of a successful shakeout. Think about this logically. If silver were truly irrelevant, there would be no need to constantly explain why it doesn't matter. Assets that don't matter are ignored, not attacked, dismissed, and repeatedly explained away. Silver attracts effort, and effort follows importance. What's coming next is not about revenge rallies or sudden explosions. It's about inevitability. Supply constraints don't care about sentiment. Industrial demand doesn't care about YouTube opinions. And governments don't reverse long-term strategies because of a chart pattern. At some point, silver will move not because people want it to, but because they have to deal with reality. And when that happens, the same people who told you silver was broken will tell you it's overbought. The same voices that mocked holders will warn about froth. That's how the cycle always completes. But the most violent moves never come when people are watching closely. They come when attention is elsewhere. Right now, attention is elsewhere. That is why this phase matters more than the crash itself. If you are still here, still listening, still thinking, you are doing exactly what long-term positioning requires. You are staying engaged when the market is trying to bore you into leaving. In the final part, I'm going to tie everything together. What the crash really accomplished, what signs to watch going forward, and why the next silver move will likely catch both bulls and bears off guard. At this point, the most important thing to understand is this. The silver crash did exactly what it was supposed to do. It scared people. It exhausted them. It made them doubt themselves. And most importantly, it made them stop paying attention. That is the true success of any engineered move. Not price destruction, but attention destruction. Because when attention disappears, power concentrates. The crash wasn't meant to end the silver story. It was meant to reset who controls it. Weak hands exited. Strong hands stayed quiet. And the market returned to a state where long-term players could operate without noise. That is why asking was the crash real or manipulated is actually the wrong question. The right question is, what problem did the crash solve for the system? And the answer is simple. It restored control. But control does not mean safety. It only means delay. Silver sits at the intersection of too many unavoidable trends: energy transition, military modernization, digital infrastructure, electrification. None of these are optional. None of them are slowing. And all of them depend on silver in ways that cannot be easily substituted. You can cap price temporarily. You can influence sentiment for a while, but you cannot negotiate with physics. Every ounce of silver used in industry is an ounce removed from circulation. Every year, consumption quietly eats into available supply. And while paper contracts can be created endlessly, physical metal cannot. This is where the paper market eventually runs into reality. The next phase will not announce itself loudly. It never does. It will appear first as inconvenience, delays, tight contracts, rising premiums, disconnected from futures prices, subtle changes in language from industry insiders. None of this will trend on social media at first, but it will compound. And when price finally responds, it will not be polite. It never is after long periods of suppression. Moves become sharp, uneven, and emotionally violent. That's when confidence flips again, just in the opposite direction. That is also when latecomers rush in, believing the move came from nowhere. Didn't. It came from this phase. From boredom, from disbelief, from silence. That's why this crash was planned. Not because silver is weak, but because it is too important to be allowed to move freely when positioning is wrong. The system doesn't destroy assets it fears. It controls them. But control has a cost, and that cost is building quietly behind the scenes. This is why global silver truth exists, not to hype price targets, not to promise dates, but to help you understand structure, incentives, and cycles. Because once you understand those, price becomes the least interesting part of the story. If you're still watching this final part, you already know something most people don't. Silver didn't fail. Investors were shaken out. And those are two very different things. What comes next will not reward impatience. It never has, but it has always rewarded awareness. Before you go, I want you to do two things. First, leave a comment below and tell me honestly how this silver crash made you feel. Confused, angry, doubtful, or more curious than ever? Those comments matter because they tell me what direction to take the next deep dive on this channel. Second, share this video with someone who still believes silver crashed because the market said so. Sharing helps break the surface level. Narratives that keep people blind to how these cycles really work. Because the silver crash was not random. It was not natural. And it was not the end. It was a reset. And what comes next will not make sense to those who stopped watching. Stay sharp. Stay patient. Stay with global silver truth.